Hi there. If you hold assets abroad, understanding UK inheritance tax implications is essential before transferring wealth to family members.
Look at this Mediterranean coastal property. A successful UK-based contractor utilizes international earnings to acquire a £2 million real estate portfolio here in France. They eventually attempt to transfer these assets to their UK domiciled children. The contractor assumes their historic non-dom status, or the fact that the property sits outside British borders, protects them from the reach of HM revenue and customs. This graphic maps the financial collapse of that assumption. The transfer triggers compounded anti-avoidance rules and double taxation overlaps. The foreign property loses 40% of its value to UK inheritance tax and another 20% to local succession laws, forcing a devastating fire sale. Welcome to Pro Tax Accountant, the premier UK advisory firm for advanced tax compliance. Today, we are mapping the exact legal and mathematical pitfalls you will face when transferring overseas assets to UK domiciled family members. The Finance Act 2025 overhauled the criteria for tax exposure. Cross-border wealth transfer is no longer determined by the subjective intent of domicile, but by a strict statutory math test. Relying on old offshore structures guarantees capital destruction. Survival now requires technical compliance with the new statutory residence rules. For over 2 centuries, British inheritance tax relied on the common law concept of domicile, the country you considered your permanent home. As of April 2025, domicile is dead for tax purposes. The gateway to taxation is now a single objective metric, the long-term resident test, or LTR. This visualizes the 10 out of 20 mechanic. HMRC rolls a window across your previous 20 tax years, illuminating each year of UK residency. Hitting 10 makes you a long-term resident. Instantly, your worldwide estate is dragged into the UK inheritance tax net. The baseline cost is severe. The standard UK inheritance tax rate is 40%. On all assets exceeding the available nil rate band of £325,000. That 40% penalty applies with equal force to a consulting business in London and a holiday villa in Spain. Under HMRC guidelines, split years and treaty-relieved years are both counted as full years of residence when tallying your score for the 10 out of 20 rule. The government has eliminated geographic hiding places. If your residency math adds up to 10, HMRC has global jurisdiction over your wealth. Physically boarding a plane and leaving the UK does not sever your tax exposure. You carry an invisible liability known as the IHT tail. Take an SME director who completes 15 years of UK residency before relocating permanently to Dubai. They leave carrying a mandatory 5-year inheritance tax tail. If that director dies or makes a chargeable transfer of an overseas asset within that 5-year window, their global wealth is still fully taxed by the British government. To completely shed long-term resident status and clear your history, you must achieve 10 consecutive years of non-residence. Anything less leaves you exposed. An international exit strategy that ignores the IHT tail is structurally flawed. Prematurely transferring assets while still in the tail period will trigger the exact taxes you relocated to avoid. Gifting an asset to your children typically qualifies as a potentially exempt transfer. If you survive for 7 years after making the gift, the asset drops out of your taxable estate, but the Exchequer anticipates loopholes. This brings us to a critical anti-avoidance mechanism, the gift with reservation of benefit rule, or GROB. A GROB occurs when you transfer the legal ownership of an asset to someone else, but continue to derive a physical or economic benefit from it. Gifting a home but using it rent-free freezes the 7-year exemption clock with a padlock. On death, HMRC voids the transfer, taxing the market value at 40%. To unlock the clock, the donor must pay full market rent. Occasional payments or informal family arrangements will fail under an audit. HMRC requires strict professional evidence of commercial rent. Signing a cross-border deed of gift is useless if the physical benefit is not severed. HMRC will look right through the paperwork and tax the estate anyway. A highly dangerous misconception among international founders is assuming that paying a foreign country's succession tax automatically cancels out your UK inheritance tax. It does not. The rules are governed by double taxation conventions. Under these treaties, the country where the physical asset sits always has primary taxing rights. Look at this matrix. Due to the long-term resident rule, the UK will attempt to tax that same foreign asset a second time, creating a double charge in the red zone. To resolve this, a mathematical relief formula offsets the overlap, but relief is never automatic. Executors must source the correct treaty, prove the foreign tax was paid, and proactively claim foreign tax credits. Furthermore, many directors wrongly assumed that the old offshore excluded property trusts they built years ago still protect them from these overlapping charges. Since October 2024, if a long-term resident adds capital to those offshore trusts, they face harsh new penalties, including periodic 6% anniversary charges and capital exit taxes. Passive reliance on geographical borders or outdated trust structures guarantees double taxation. Surviving the modern tax code requires active treaty claims and structural updates. The shift to a mathematical, residence-based system alters the geometry of international wealth transfer. If business founders, contractors, and expats rely on old non-dom assumptions, the result will be catastrophic capital erosion driven by double taxation and unmitigated GROB penalties. The only defense is early cross-border estate planning. You must quantify your 10 out of 20 timeline, align the laws of multiple jurisdictions, and actively utilize bilateral treaty reliefs. This video is for educational purposes only, reflects rules as of 2026, and does not constitute formal financial, legal, or tax advice. Individual circumstances vary. Protecting international assets requires bespoke, professional architecture. To audit your residency status and secure your estate, contact the experts at Pro Tax Accountant. Do not leave your family's legacy to legislative chance. Subscribe to the Pro Tax Accountant channel for continued